Hey, what's going on YouTube? Kenny here. So today I'm going to show you how to set up a trade, like literally from scratch, how I look at the macro conditions, how I set up my scanner, how I found the trade, why I think it's a good trade. And this is all stuff that you can do. So if you're new to this channel, Redcliffe Research is a quant-heavy data analytics-driven research company that likes to deal with signal detection, looking for anomalies in the noise, and just sorting out through the noise in general. That said, we do take a lot of qualitative macro trades as well, but of the trades that we want to take when it comes to this, we want to be very specific. We want to use a specific strategy, and we're going to show you how you can do it yourself and how I took this trade, or am about to take this trade, and I figured we might do it with a real trade that I kind of found today. So this is going to be a day zero of the Redcliffe Research Investing Essentials class that's going to be free to our Patreons. Hopefully, if you're a Patreon, sign up for it. It's going to be live 5 days. I'm going to go through everything, and I'll show you on the back end what that entails and everything like that. But yeah, you're going to get that one. You're going to get the options course. You're going to get a bunch of other stuff as well, and also the day trading course as well. Anyways, was it day trading? Not day trading. The tactical trading course. I'm sorry. That said, we do everything here in one take. So if you like that kind of thing, cool. If not, then yeah, sorry. Yeah, we've tried to do cuts and stuff, but people think it's unnatural. And to be honest, you want it. A lot of folks find it not just amusing, but I think beneficial when they see me looking for stuff and looking through stuff. So yeah, you can always fast forward. But let's go ahead and get into the kind of class right now. So again, this is day zero, and then we will set up the day 1 through 5. And I hope you can join us if you're a Patreon. And if not, you'll have the replay, of course, and we'll start setting up a library for all that stuff. But this will be the absolute Redcliffe Research Investing Essentials. And again, this is day zero, and I want to talk to you about just setting up the trade, and we'll do it in real time. And again, this trade is Dropbox. All right, so we're going to take the bottom-up approach. So there's a couple ways to do this. The thing is, we have 7 categories here, as you can see, marked here with the 7. But really, the defining feature is the macro is the most important. If you get the macro right, everything else falls into place. So even when you talk about a bottom-up approach, we still start with macro as one. These can come and vary in certain kind of different different sequencing, but in general, macro is always going to be one, even if it's bottom up. But then if we do it the inverse, we can reverse a lot of this stuff if we're trying to do the top down approach and take a macro first and say, okay, a macro first approach would look something like this. I think financials are going to do very well because of the yield rates, right? So now I got to go look down for financials. So you say to yourself, what are the top financial stocks in this universe? Then you set up your scanner on that, and then you would go down that rabbit hole. Here, we're doing it quite the opposite. We're doing the bottom-up approach. So even though we're doing it the bottom-up approach, we still say, hey, what are the macro conditions looking like? And then I go into my pattern, and then I set up my screener. So I'm just going to show you how I did it and how we're going to go about doing it here. All right, so again, starting with macro, the first thing I want to ask myself, and we'll start here on the right, is what is the overall state of the market? Is it bullish? Is it bearish? Is it kangaroo or choppy is really what I call it, but some people call it kangaroo or sideways. I think that's just a funny thing that people say. I don't know if people actually call it that, but I seen it one time. I seen it on the CNBC, so I'm going to call it. But anyways, I think it is a choppy market right now. And so what defines market chop? Essentially, there's no trend to the upside or no trend to the downside. And this is pretty indicative of kind of year 2 of a recovery from a recession or a V bottom. And so it's nothing that we didn't expect. We are expecting a pullback on the S&P. And even if we finish at 440 at the end of the year, I don't think it'd be the worst thing, because we're already up like what, 18% already mid-year. So still doing really well, but a lot of chop. And so this is what I'm defining the market as. And if you go ahead and our Patreon, one of the things we'll send you is I'll send you my essentials kind of checklist and Excel spreadsheet. It has a bunch of things in it. It shows and we'll show you how to use all this stuff, like price targets, just overall scoring rubrics, compound interest calculator. You'll have a checklist of these things when you want to take a trade. You can kind of go through it. It'll ask these questions, and you can kind of write it in there. And so we'll have that all for you if you are a Patreon, so no worries about that. And we'll start sending all that stuff out pretty soon. Should have this done in the next 2 weeks. It's just going through a bunch of iterations right now. But anyways, I'm not here for that. Let's keep going. How can you exploit this as a retail investor? Okay, so if I'm saying it's chop, how can we exploit that, right? So for instance, one theory that you could say to yourself is, choppy action looks like this, right? And it can be very volatile, but it can chop back and forth. So knowing that, channel trading, any kind of condor, iron condor type of thing will work. Selling premium could probably work. A lot of different just going long volatility could probably work as well. Okay, so some of these are pretty complicated strategies, but we're going to talk about one thing that is very simple when it comes to chop, and the strategy that I'm be taking. And that strategy is indeed an all-time high strategy. And I'll show you what that looks like when we get to the chart. And I just want to remind you what the retail advantages are. So you're nimble. And that with that nimbility, that's not a word, with that nimbleness comes liquidity. Essentially, you don't have to move 1 million shares. You don't have to stare at a computer to see if we're below VWAP and if you can start, getting your portfolio target weight to a certain level, that kind of thing. The idea here is, if you ever thought like, who's buying at that level when like the floors are coming down? It's those dudes that were staring at the computer, really waiting, months and months to kind of get their portfolio allocation to a certain point. Those are the people buying there. You don't have to worry about that. You can just stay away from that kind of stuff, and that's kind of nonsense. You don't answer anybody. So you can change your thesis at any time, and you can essentially take trades that are bonkers. People are going to tell you not to do all that stuff, but they do it themselves. And the idea here is like, really, if you can justify it, do it, because you are your own trader, you are your own hedge fund. Anyways, the point is, you can take these trades. You don't have to answer to a board. You don't have to get anybody's consensus to tell you that, hey, that's a good or bad idea, and to change your trading strategy in mid-cycle or halfway through the quarter would be fucking disastrous if you're a big fund. But here you can do all that stuff. You don't have any marketing or branding. A good, for instance, this, and I'll just keep this short, but look at the ARK fund. They invariably can't do anything different. They have to do that. They can't just say, well, tech is bleeding off, so let's not buy any more tech stocks. No, that is their, modus operandi. So they have to kind of, keep doing that thing, right? It's the same thing why you could say that Warren Buffett wasn't able to buy Amazon. It just didn't fit his style of investing at the time. And obviously now he owns pieces of it. But I mean, before they just couldn't get himself to do it, right? So you're not bound by any of those weird restrictions. Okay. The other thing is no regulations. And again, no kind of diversity caps. You don't have to justify a 5% plus weight in your portfolio of a specific stock. You don't have to do any weird filings. You just buy it. You can have 100% weight. And you can be very contrarian. The thing I want to say about being contrarian is like not to say it just to do it, but essentially the idea here is, the market inefficiencies come with consensus, right? When there's too much consensus on one side, and we'll talk about this more later, but if there's a ton of consensus and everybody thinks it's going to go one way, the inefficiency is in the other spot, is in the other direction, right? Where it's less liquid. Okay, excuse me. Okay, so when it comes to actually telling your macro story, tell it like a story. What do you see happening? What indicators are affecting the markets? There was a time when the bond rates were really affecting the markets, or maybe, depending on how you saw it. But if you thought that that was the way that it plays out, then, set up a thesis. That way, if it goes wrong or things change, you can kind of see how that kind of plays out. And it's important for you to do it because you have to know what you're thinking in terms of how it affects the market. And it can be wrong, but the point is, the very smartest people in the world disagree with each other. So we're all on equal all on an equal level playing field. So don't think that your opinion doesn't matter here. It does for quite a bunch of different reasons, but the main reason is because you need to know yourself what you're thinking. Again, where do you see the market by the end of the year? That's an important one. And finally, will the macro hold up through the duration of the trade? There's a couple questions that you'll want to ask yourself about the macro conditions. And so what we see here is, I will say that it is a choppy market. And I would say that in terms of indicators affecting the markets, a lot of different things that we're looking at, emerging indicators from emerging markets, but really market breadth is the one thing that I'm looking at that doesn't make sense to me. So with the market breadth being so detached from the top movers, and if you don't know what market breadth is, it just says majority of the stocks in a pool of stocks are not participating in the upward rally, right? And so if you take a look at what the market breadth looks like nowadays, very recently here in this week, yeah, there is abysmal type of drawdowns for most stocks, and like the top 20% of stocks, especially S&P wise, are the prime movers and carrying the entire market. So with that detachment, I would say it's a choppy market, and those are kind of indicators that I'm watching that are reflecting that. I would say also macro-wise, coronavirus is big with the Delta variant. I think a lot of it's noise, and I think the market has kind of learned to just figure that out. But I do think that there's a little bit of fear lingering there. And in terms of will the macro hold up through the duration of the trade, I do think it will. So yes on that one. And so now I can kind of move off from that and think about how I'm going to take the trade. Okay, so this is pattern. So the one thing that we want to do is we want to screen for profitable patterns. And if you're new here, one of the patterns that we have talked about over and over again is one of the most compelling patterns for us. It has like a 91% according to our pattern analysis engine. 91% statistically significant chance of success, and depending on where the channel starts, right? And depending where the machine learning pattern analysis tool picks it up. Anyways, that said, you want to start with that. If you're not familiar with patterns, then we'll definitely teach you that in the course coming up. But the second thing you want to do is identify companies you know in the pool or the universe of stocks, or the cross-section method is what we'll talk about in a second here, and I'll show you that in the next slide. But essentially, this is oops, sorry. This here is, wow. Okay, here you go. This is your channel up, right? So you can see it starts here and it's just goes up in a really, really nice channel. And so if you like drawing trend lines, this is the one where you could actually draw trend lines. And if you know from our channel, we don't generally use trend lines, but this is the time to use the Fugazi magic. Just make sure it's logarithmic and it's consistent. If you want to use linear, have at it, but logarithmic should be a lot cleaner, and it should be more accurate as you scale through the chart. Okay, so how do you find these types of things? Well, FinViz is a great screener rather. So what you do is just go finviz.com. What I did is I went for a large market cap. I actually want large market cap stocks that just graduated to large market cap, so showing a demonstrative move from the mid cap to large cap. Some folks start from small to mid. That's probably even better if you're really good at this stuff. But you know, just for the sake of risk and taking less risk, we're doing large cap, but just graduated from mid cap to large cap. So I went down the list, and I also said, hey, give me on the technicals, and you don't see it here, but on the technicals I said channel up strong. Okay, so what we found was you know, a couple names that we saw that were pretty compelling to us, and we kind of sorted by that. Most of them financials, so financials are definitely rallying. Morgan Stanley is a really interesting play that I'm all about, but we have exposure to XLF right now, so I'm not going to take that. Honda Motors had an interesting one, but Dropbox is a tech stock that fills all the kind of wickets. SaaS model, all that stuff. So trading at $32.22 with a 2% move yesterday. And so in terms of volume, this is important to me. taking a look at this volume, 7.8 million. Because even if you say I like Honda, I like the story, I like the catch-up trade for the electric vehicle market, and I do think they'll do something. You're only looking at 397,000 in volume shares traded, and so we want this 7.8 million. The volume is dramatic, definitely for Dropbox. It's in a place that we know and we can play, and it's also something that we've seen over and over again recently in our group chats for sure. But this is one of those ones where it's kind of like that fusion thinking. And if you don't know what I mean by that, it's just like if you see it somewhere and then you see it again and you see it again, you're like, okay, there's something to this right now because I'm not even looking for it and I see it. So this is kind of what you want to see. And then you want to think about how other generational cohorts will view this stock, so your boomers, your millennials, is there a cross section, right? And so, that's how you want to look at that. Does this check that box? Yeah, I think people are going to use Dropbox. Okay, but here's the deal. So why are we staying away from Morgan Stanley or any of these other companies? If you don't know who they are, you can still trade them. But if you do know who they are, that kind of gives you an edge. You kind of know what it is, and it has crossed your path. And so you're not just going in there completely blind and discounting everything, which is okay to do a lot of time, but depending on your trading strategy. But here we're going for the kind of name that we know. That way we feel a lot more comfortable with it, especially when it comes time to do our due diligence. So technicals. What you want to ask yourself is the following, like where is support? Where is resistance? Is this a breakout or a breakdown? Meaning, so for instance, this is the Ford chart. So if we were trading up here, like now, it's on this floor right here. Is this support? I would say that this is support, right? A breakdown would be like a gap down or a gap up like this. Is there a chance for a breakdown? Yes. Has this hit support? Yes. Probably. Are we in no man's land? So no man's land would be somewhere like right here. You never want to take a trade in no man's land. Unfortunately for Ford, it did not look at like no man's land here because we were pushing at all-time highs, and the strategy kind of failed us here a little bit. But that said, this wasn't quite the channel up or the ladder step that we were looking for, but we were looking at the qualitative story, and we were looking at the kind of numbers surrounding the earnings and all that other stuff. So our thesis is still holding up. So we're still holding this trade here in Ford, but the point is, are we in no man's land? If you can easily kind of look at a chart and it's like a sideways channel like CHOP, so we're talking about CHOP this year, right? If it's like right here in the middle, like Intel is right now, if it's trading in this mean reversion line here, then you want to go ahead and stay away. And then what technical analysis makes sense for this trade? Again, we don't like to use trend lines that much when it comes to these diagonal trend lines. We do use horizontal lines because for us, it's the most kind of solid, very honest channel when it comes to just thinking about price lines. But, there is definitely something to having the understanding of institutional memory, kind of just like where folks are in line to buy or where folks think a good place is to buy. And so you just have to ask yourself, is this a good entry? And we're going to talk about that right now and how you might think about entering a trade. Okay, so again, so this is actual Dropbox right here. So the three kind of lines that I've made, I've always tried to get at least 3 lines. If not, then it's probably a new stock. But when I'm looking at support and resistance, obviously we kind of had this overhead supply that needs to get absorbed here. And if you bought on IPO, you've been kind of holding the bag for, 2 years now, 2.5 years you've been holding the bag. So, the pain train is here. If it can absorb all this supply, this can definitely go for a ride, and it's at a very critical level. But here's a couple things that you might want to look at when it comes to this. Again, I draw these lines because this is where essentially it hits the most in terms of where it's kind of just touching. So this line here at 23.49, if you want to call it 23.50 or 25, that's probably okay too if you're just trying to round out. And the idea is, nobody knows exactly, so that's why you I also draw these lines quite thick because they're just a guess. 18 seems solid for a floor here. Seems like it respected it very well, except for this little weird bottoming over here. But again, the reason why I draw this like this is because we say this spike here is noise and this is noise. So we want to effectively show we don't want to effectively show what the noise is, because this noise is it's kind of incalculable. It's like, you know, like the tanker sitting at $0. And then moving from there, we're right back up last year. You know, these are things that you cannot control or account for, but in terms of trend, you can account for this. And if you get the spikes up and the noise going up, yeah, that's when you sell because the volatility is going to help you out on that. Okay. This is Fibonacci extensions, and it's Fugazi magic for the most part. But you know what? Because everybody has a level playing field, one things you might want to take in consideration is like what other people are looking at. When it comes to all-time highs, this is the only thing that you can really use that technical traders may use. So that's why I look at it. I don't use it myself. I do think it's Fugazi magic. I've back tested it a bunch, and the problem is you can't. It's tough to really put tough to get an accurate reading on some of this stuff, because like where do you draw the lines and all this stuff really makes a difference. But if you go by the rule book here, and you know, for here, I think we started it here, right? And then we went up and then went down and then we drew it here. And this is looking at the next retracement. So what Fibonacci retracement and extensions try to do, and this is extension, is it takes this impulse, right? That first impulse, not the retracement, that first impulse, and it tries to give it the extension, and it uses the golden ratio, which is found in nature, et cetera, et cetera. Anyways, traders use it. As you can see right here, we're kind of like fighting off this top here. But you could say it was that, or you could say, hey, look, there's a supply here that needs to be absorbed before it can make a move up. And so, you know, in general, if they kind of line up, I'll take it. So when it comes to all-time highs, and again, back test this yourself, think about your own strategies, but, you know, as an all-time high strategy, and we'll explain that in the course coming up here. But, you know, if you back test all-time high strategy, one of the things we use for all-time highs for price targets is not only a fundamental price target, based on a bunch of different things and how we do it at Redcliffe Research. But one of the things we use is Fibonacci extensions to kind of check our work. If it makes sense that there's a cross-section, then we're a lot more comfortable. So yeah, just something to think about. The other thing I want to think about here is there a pattern? So on the daily chart here, there's an emerging pattern. And that pattern is obviously a cup and handle, right? So meaning there could be a handle and then it takes off. That said, this trade in terms of time frame, and we'll talk about time frames, would not survive that. So I'm not looking at a kind of quarterly or half-year trade, which I think would essentially happen if it doesn't break out here. So it needs to break out here, and we'll probably play tight stops Tony here, but I'll show you how we're setting that up. This is the DeMark indicator, and it shows trend exhaustion. So if you're new to this channel, one of the things we look at is DeMark, and it essentially uses a formula that calculates when a trend can change on itself. Anyways, 9s are medium exhaustion and 13s are extreme exhaustion. Why does that matter? Well, really, it only matters for entries. You just don't want to take it when other technical traders are looking at it. So if you didn't know, like the DeMark indicators, you know, if you want to think it's Fugazi magic, that's fine, but it's probably one of the ones that works the best on certain stocks, especially for entries and exits. And it's also included in like the Bloomberg terminal, which is like, you know, $100,000 a month or whatever it is. I don't know what it is. It's a lot. It's like tens of thousands of dollars a month, but it's included in the Bloomberg terminal. Here you can get it from DeMark, and you know, I don't have any sponsorship with them or anything like that, so I'm not trying to shield it, but I'm just saying this is where I get it from. So the 9s here. Showing the top, a 9 here that failed, didn't really work, 13 here didn't really work, but that's why these dotted lines show up. It's showing that, hey, it did not pull back down within 4 days, and so because of that, you know, the trend can continue. what's my point? We are at what we would call a perfect sell setup right now. And so if it passes through here, then the mark indicators are saying that it can definitely run some more. That said, not buying here yet, but I'm watching for the breakout, and I'll show you why in a second here. Okay, let's just go over fundamentals real quick. This is going to be not a course on fundamentals at all, but I will just show you some of the things that we look at. So we go to Finbox, and I've categorically kind of taken these and set it up in my kind of portfolio profile of things I want to look at. And so, you know, I kind of take a look at these and give them a score. And so the PE ratio is actually on the way up here, so getting profitable. In fact, I know we're still negative, but we're not at some silly, well, it's still a silly retarded number, but it's a number that's going up. That's the trend. Okay, so there's a path to profits, which is probably why the stock price is doing that. Revenue going up. That's great. Check mark, check mark. CAGR, 26% for 5-year CAGR. That seems a little bit low to me when it comes to a SaaS company, but check mark anyways. We'll see how that plays out as we do more due diligence. But really, this is a technical trade, so I'm not quite worried about that. But I just want to make sure there's no like kind of bankruptcy risk or something really retarded. Not retarded, I'm sorry. Something that is just doesn't make sense to me in kind of the books here. Levered free cash flow. This is one of the most important ones for us. Tells a really true story of what the balance sheet looks like, and this is looking really good right now. Gross profit margin is amazing. It's amazing, but it's actually a little bit low for a like a SaaS company. But the cool thing is it's been really steady and kind of going up. So they're squeezing out margin here and there every year, and so that's good. Excuse me. Profits going up, shares outstanding going down, which means they're buying back shares. Really, really a good sign, or a bad sign depending on who you think. But you know, flat is generally the best. But in a growth company like this, with a market cap of what is it, 12 bill? I don't know. We'll see. Total assets going up, but total current liabilities going up as well. Current ratio of 1.8, very solid, holding probably a little bit too much money, not too much money, but the right amount of money. It's actually very good. Book to value to share ratio. Only have this when we look at risk and risk of bankruptcy, just kind of thinking through like how much our shares worth, what the book value of the company is. Book value meaning if you go bankrupt and you sell the company, a book value of 1 means for like all the equipment you sell, like, you know, sell a paperclip for $1, you get $1 back, right? So this is trading at a negative book value. So, and this is just tip ranks. We use this as a consensus score or a smoothing score, but really essentially all we're trying to do is like make sure that we're not so far out there and just kind of checking our work, you know, not making sure we're not super contrarian or, you know, overly bullish on a certain stock. And again, this is about where I think Dropbox is. But, you know, we do have our own scoring rubric and our own scoring price targets that we use. And we'll show you all how to use that too when you take the course. Anyways, but that said, we just look at this just to see where we're at. Everything is looking real positive here. Insider activities and NA, not enough data there, but return on equity for the trailing 12 months is a negative 50%. But I mean, for a growth stock, I'm not too worried about that, but it's outperforming. And then with the analyst price targets, if you don't want to use tip ranks or you don't have a subscription, Wall Street Journal and Yahoo Finance does this for free, as well as just says analyst consensus is what you're looking for right here, that word. But seriously, what you're looking at is a 13.28% upside, which actually matches the fib top side ish, and I'll show you. So 36.50 is the kind of average price target. Some people are saying 40. And this is for 12 to 18 months out. But I don't think our trade is going to last that long. Ours looks like it's going to set up until November, August, September, October, November, 3 months. And show you what that looks like. Okay, and this is why I say fib sucks sometimes. And so I redrew this like 4 or 5 times. And finally I got to one that I felt was the closest or the most the best, and the best meaning most accurate from my little shaky baky hands drawing to these candles, right? But anyways, my point is, you saw the other one. It was tipping over here at 1.618. But here you can see there's still room to run, about 5% to run to the upside. Looking at about 434 as this top line. What is my point? Waiting here. And if we cross 34 strongly, we will get long here at 34. So it's quite a wait to get into this trade. You could also say from here, channel up is a 90% kind of confidence score. You could probably risk it and play tight stop Tony here as well, because you can essentially get to 34 and then if on the break at 34 go long. But the idea here is you should be patient. It should be boring. So what you want to do is set an alarm for 34, set that bell for 34. Once it crosses 34, then you would go ahead and take a position, and then you would have all this upside here to possibly 40. And as you can see here, $40.06 matches the highest price target for this analyst, and the average price target of $36.50 back over here. Split the difference on this, but honestly, definitely could hit range here and just go for broke over here. And so again, at Redcliffe Research, one of the things we like to do is we like to buy those stocks on the dip, but right now dip buying isn't working because the trend is just not our friend at all right now. It's super choppy. So with that, when you're buying those dips, it's easy to call out prices to targets because we've already been there. But when you're talking about all-time highs, you have to do really good price target analysis and good fundamental analysis. But for a trade, you just want to make sure there's room to the top side, and then just kind of figure out for yourself what you think is realistic. And you can do that a lot of ways. And there's some really stupid, easy ways to do it that probably work, that would not be overthinking it. So the way you want to set up your trade, if you have TradingView, this is a really simple way to do it. There's a risk-reward ratio. Go 2 to 1, 1.5 to 1 is the minimum probably here for a trade, but 2 to 1 is very, very sensible. So you have your stop here. If you wanted to take this trade today at $32, what you would do is you have 5.37% upside, and you have a stop over here, down here at 31.33, and then obviously 33.92 is your top side target before we hit any kind of resistance. So I might actually take this trade and then thin out my position or completely eliminate the position and then wait to see if it can cross 33. Here is what I want to take though. Again, set the bell for notification here. 33.97 would be the bell. If it clicks, if it passes through 33.97, basically 34 strongly, then we want to get long, and then our price target's 39.28. And so this one would have a downside again of a 2 to 1 ratio over here, 2.04 to 1. But I mean, obviously, stop at 31.29. Top side goes up all the way to 39.28, and obviously I have these target levels undercutting a little bit just so we don't get blasted out or whipsawed out if he hits the top and rejects really hard. So instead of putting 40, I put 39.28, and it's the same reason why we put 118 for AMD. And as you saw, like to the T, it got to 120, so you could have gotten 120, but you saw it get to 122 and then whipsaw it back down. And so that's kind of why we put the price target at 118, just to kind of front run kind of the algos. So when we're talking about instruments, right, after you figure out kind of where you want to technically take the trade, you have to figure out if options is right for you and what type of options, or if it's just going to be a raw equity and a long position. Most of the time, especially if you're a beginner, you just want to take raw equity. But if you want to put any kind of leverage on, you want to take a look at the options. And so one of the reasons why you want to take options is because the implied volatility is below the historical average. So this is just a tool that you can use, this Market Chameleon. You just go to the implied volatility, you search for it, and you take the implied volatility, and then you take the 30-day moving average of that implied volatility, and you see where it stands. So in the orange is the 30-day average, And so the average is here, right there, at 39.2, and we are now at 38.7, meaning this is a good deal because you're not buying a volatile option, and volatile options are more expensive. And so right now would be a good time to buy it before the volatility starts spinning up. And so when we look at volatility, the way you should look at it is it's mean reverting, meaning if you can see here, all these tops, they always go back to this orange line. This top goes back to this orange line. It always goes back to the orange line. This bottom goes back to the orange line. So whereas in a stock price, it doesn't have to come back down. It can go up in perpetuity. Volatility, and this is why we were talking about the complicated notion of going long volatility, but that's for a different class. But still, here you can see it can go up, extend, and it will come down. Even if it extends to the downside, it will come back up and hit the mean reversion line. And you're like, Kenny, over time, though, this mean reversion line is moving, right? Like, yeah, it's the moving average. But in essence, even if you called the midpoints, right, it would work the same way. Again, volatility is just a number that is trying to calculate, how volatile the stock is. So it would be mean reverting. Point is, you're buying now when options are cheap. And this is why I'm interested in taking this trade right here, even though we have this top side rejection that might happen. Still very interested in taking this trade because the implied volatility right now is very low. So the Vega, for you guys keeping track with the Greeks and all that stuff. Anyways, and then we would go ahead and build out a solution. And this one has a very interesting one. In fact, I think if we get to our price target on this one, you get a very, very decent, like 150% or something like that. Today is not the day we'll talk about this, but again, if you're Patreon, all these courses are coming to you. We're building out a huge library. You're going to have everything. So you're going to start with the essentials of investing, how we do it. Redcliffe Research will get all the tools. And then on the second one, we're going to show you how to do the tactical trading piece for those who want to do shorter trades, talking 1 week to a month. And then we're going to take you through the options trading, and then we'll do some advanced strategies even after that. So we're definitely building out an entire library for you all. So just want to thank everybody for sticking around and supporting us. It means the world to us. And yeah, we're not wasting the money, and we are definitely investing in a lot of different software, a lot of different kind of tools that you'll be able to use very soon here. Tools like the one that Jeffrey showed off on the Slack chat. Things like that are coming to fruition very soon here. And yeah, I'm going to stop right there when it comes to just the actual talking about the trade itself, because that kind of finishes the trade. But I do want to talk to you about, what you're going to see if you're Patreon and you go through the course coming up. So day one, we're going to go through mindset, thinking like an investor. A lot of that is going to be things that you've probably already thought about, but some things here might be not as kind of obvious as you might think. Goal setting. Essentially, we got to really figure out why you're investing, because that's the biggest thing, right? So just different strokes for different folks, that kind of thing. And choosing the best broker for you, depending on what you're trying to do. And then stock picking, our system's approach to it, checklist by checklist, just going down the checklist. And then obviously telling you or teaching you how to kind of massage it for yourself for what works for you and what is kind of critical to that stock picking approach, and what you could probably take out and change, and what's kind of just our secret sauce. Day two, we're going to go through comparables, really set you up to understand that there's really two baskets of stocks in the universe. It's growth versus value. And just, really talking about how you value those types of things. One is super speculative and can carry absolutely any kind of valuation you want, i.e. Tesla. And the other is a very numbers-based game. It should be super efficient, and so you shouldn't be buying at certain points, no matter how good it looks, because there's no other kind of, I would say, kind of dark horse growth that's kind of built in, or anything that they're trying to do that might give you outsized growth in the future. Take a look at revenues, ratios, and cash flows. It's not that complicated. We'll break it down very simply for you. Just the ones that you want to start learning if you don't know anything about any of this stuff. But yeah, we'll just break it down very simply. Marcus will go ahead and host that, I think. And then price targets. Show you how to develop your own price target. And it can be as easy as saying, okay, I will just use the consensus price target for analysts. That's not what we're going to show you. We're going to show you a super complicated method that is quite simple, but very complicated when it comes to thinking through it and designing it. But now that it's designed, I think it's really easy to use, and you should be able to get a decent price target based on your probability of risk and your probability of risk assignment of certain things. And we'll show you how to do that. You'll just literally calculate. You'll say, okay, how likely is this company to go out of business? You assign a percentage, and then it'll equate that probability at the end of the day. And so just kind of give you a voice in this whole cloud of madness instead of just accepting what an analyst is saying. But then also weighting that too. And so we'll talk about that. Definitely we'll talk about market cap, because I think this is the most misunderstood thing when it comes to the whole stock market. Especially when people first start and don't understand market cap. They're just like, stocks go up, and so Ripple can go to whatever because it's only a penny. That's not the way it works. Day 3, 4 most important market indicators. This is a special one to me, near and dear to my heart. Definitely want to share that with folks. I think I've probably gone through most of them, but I want to break down the statistics and kind of show you what that actually looks like. Obviously, understanding sectors and sector rotation is going to be super important to us, and we'll kind of talk about that. And then, is seasonality important? Just our thoughts about that and how to think about data. This is a big one, and that I think people kind of misunderstand. We'll go through tip ranks and tell you kind of like the flaws of it and kind of where it shines. Go through Macro Access, Simply Wall Street, all those big names, Seeking Alpha. Just show you how they're kind of putting their data together. And then just talking you through what you're actually seeing and why it's probably not right and probably why it might be right. So just giving you both sides of the trade and just talking you through why they're doing that and how accurate it is. And it's just not a perfection thing. And so again, the markets are inefficient, and that's why we can extract what they call alpha, which means you're beating the markets. Day 4, all technicals. Mostly technicals, mostly timing strategies, but at the end, we'll go through scoring to kind of hit you up and kind of take you through the whole process when it comes to assigning a score to it. And the reason why you want to assign a score to it is because you might invariably come up to a stock where, you pick your favorite stock and you do a, buys free kind of scoring rubric on it, and say you get like a 90. Right, on that stock. Great. Now you know that it's 90. So now you say there's some crap stock that you don't like really, but you do a full scoring rubric on it and it comes out like 92 or something. Then maybe you should give it some attention, And so this is what that's for, right? And so this is kind of a ridiculous example, but you get my point. If most stocks that you're scoring are 50 and Redcliffe average is a 50, for instance, then we're probably in the same kind of universe and we're thinking the same. But if, for instance, I'm scoring, Redcliffe scores a stock at 60 and you score it at like 75, why is that? What's the story that you're telling? Equally, if you have a price target and a score of like, for instance, 9 out of 10 on a stock, and then Tip Ranks gives it like a 7, what are the bullish features? What are you missing? Or what are you overweighting that they are not seeing? As long as you can tell that story, you can justify that, then take that trade. You should always try to justify your trades. You don't have to justify not taking a trade. That's too easy. Just don't take it. But you should justify your trades and why you're taking it. Day 5, it's about strategies. And the reason is because we want to bring it back home and give you a way to trade. And so obviously we're going to talk to you about one of our premier strategies, the blue chip loop strategy, which we use for Costco, that we picked up a while back, and it's basically gone ballistic. Those options, geez, they're printed so heavily, it's ridiculous. Hundreds of %. And then the all-time high strategy, you saw a piece of it here, but we'll break down the statistics and kind of break down the theory and then break down everything else when it has to do with the actual strategy itself. And then obviously we'll go through a recap. So that is not it. And then in October, we're going to go through tactical trading and then November options. And then after that, we'll finally get to some advanced stuff and then some machine learning, AI, and just thinking about stuff in that way. But those are very, very nuanced things that only certain people care about, but we'll get the breadth and the depth through all these 3 courses in the beginning. And so all these are live. Again, if you're a Patreon, you will be able to check them all out. Anyways, that was probably our longest video, but yeah, hopefully you liked that video and you like this kind of thing. If you do, we do have a macro newsletter that's going out actually today. It's really late. Sorry, folks. It's going out today. I'm going to do it right after this. I was trapped in the middle of France somewhere. I had a flat tire. It was really bad. So we got back late, all that stuff. But apologies for that for the folks who are watching. But yeah, we have a very special couple of videos coming up. One, Colby did a interview with the GMBL CEO. Awesome interview by Colby. Got to get that published. It's coming up soon. And then Tuesday, we have Nathan again from the space guy, as you know him. He's going to be talking all space stuff, and we'll be doing the live stream on Tuesday with him and Marcus. So that's a really, really cool one. We got some cool stuff lined up and a big announcement coming up on that day as well. So we'll see you on Monday, and then we'll obviously see you on Tuesday. So thanks for watching, and we will see you tomorrow. Take care.